If the headlines scream that the economy is booming, why do so many feel like they're all falling behind? Since 1979, American workers have made the country 87% more productive, yet their pay rose barely one-third as much. The system was supposed to reward hard work. Instead, the gap between what we produce and what we take home has quietly turned into the biggest economic riddle of our time. The answer is not just about economics. It reveals who the economy is really designed to serve. So where does all that missing value actually go? From 1979 to 2025, American workers drove a surge in productivity, an 87.3% increase according to the Bureau of Labor Statistics. Yet over the same years, typical hourly pay grew only 32.7%. The gap between what workers produce and what they earn has widened into a chasm, leaving more than half of those gains unaccounted for in paychecks. Economic Policy Institute charts make the split impossible to ignore. While the value created by each hour of work nearly doubled, the reward for that work lagged far behind. The numbers are not a matter of debate. Productivity and pay once rose in tandem, but by the early 1980s, the lines began to diverge. By 2025, the difference is not subtle. It is more than 50 percentage points. Labor's share of the nation's income fell from about 57% in 1979 to a much smaller slice today, as more and more of each dollar generated by the economy flows elsewhere. Economist Heather Bushey describes this as the central paradox of our era. We have an economy that's more productive than ever, but the typical worker isn't seeing the benefit, she says. Charts from the Economic Policy Institute and the Bureau of Labor Statistics show the lines splitting apart year after year. The question that follows is both simple and uncomfortable. If workers are producing so much more, who is capturing the rest? The numbers demand a closer look at where the surplus value is actually going. Each year, trillions of dollars flow through the American economy. But when you trace the path of all that value, from the goods and services workers create to the profits and paychecks that result, the pattern is anything but straightforward. Imagine a river splitting into separate streams. One stream feeds workers' wages, another fills corporate profits, and a third pools into executive pay and shareholder returns. Over the last 4 decades, the stream feeding wages has narrowed, while the others have swelled. Labor's share of national income dropped from 57% in 1979 to well below half today, as more of each dollar created by the economy is redirected away from the typical worker. A Sankey flow diagram makes this split impossible to ignore. Out of every $100 in new value produced, less and less lands in workers' pockets. The rest is captured in rising corporate profits, record-breaking buybacks, and ballooning executive compensation. S&P 500 companies distributed more than $13 trillion in buybacks and dividends between 1980 and 2022, with buybacks alone topping $1 trillion a year after the 2017 tax cuts. Meanwhile, CEO pay has soared from 30 times the average worker's wage in 1978 to over 340 times today, most of it tied to stock performance and buybacks. This is not just a story of numbers. It is a story of rules. Rules that decide how value flows, who writes the checks, and who cashes them. The next question is not just where the money goes, but who decides the rules that send it there. In 1982, a little-noticed rule change at the Securities and Exchange Commission rewrote the playbook for corporate America. Rule 10b-18, tucked into the Federal Register that November, gave companies a legal green light to buy back their own stock on the open market, so long as they followed a handful of technical conditions. The volume cap was set at 25% of average daily trading, with restrictions on timing and price, but the real breakthrough was the safe harbor it created. As long as companies stayed within the lines, they were shielded from accusations of market manipulation. Before this rule, buybacks were rare and risky. Executives worried that aggressive repurchases could trigger SEC investigations or lawsuits from shareholders. But Wall Street firms and corporate lobbyists pressed for clarity and flexibility, flooding the SEC with comment letters and meeting with commissioners behind closed doors. Industry voices argued that buybacks would help stabilize markets and return capital to shareholders. SEC Chair John Shad, a former Wall Street executive, championed the change, emphasizing the need to reduce regulatory uncertainty and boost market liquidity. Critics warned that the rule would open the door to abuse, letting executives use company cash to prop up share prices and inflate their own stock-based pay. But the SEC dismissed those concerns, pointing to the new limits as sufficient safeguards. Over the next 4 decades, buybacks exploded, from less than 2% of GDP in the early 1980s to nearly 4% by 2022, with S&P 500 firms alone spending over $13 trillion on repurchases and dividends since 1980. Susan Rose Ackerman, a leading scholar on regulatory capture, describes Rule 10b-18 as a textbook case of industry influence, a policy written with heavy input from those who stood to gain the most. The rule did not just change how companies handled their cash, it quietly shifted the balance of power in the economy, redirecting value from workers and long-term investment to shareholders and executives. In October 2008, as the financial system teetered, Congress authorized $700 billion for the Troubled Asset Relief Program, TARP. The goal was clear: prevent the collapse of the nation's largest banks, insurance giants, and Wall Street firms. Within months, the Treasury wired hundreds of billions to institutions like Citigroup, Bank of America, JP Morgan Chase, and AIG. Executives kept their bonuses. Shareholders held on to their investments. The Dow Jones rebounded. But on Main Street, the story was different. That same year, more than 2.3 million homes entered foreclosure. By 2012, over 10 million families had lost their homes, an average of 2 million households a year. The government's main homeowner relief program, HAMP, reached fewer than 2 million borrowers, while banks received the lion's share of support. Joseph Stiglitz, Nobel-winning economist, called it socialism for the rich and capitalism for the poor. Public money shielded the financial sector from the consequences of its own risk, while ordinary Americans bore the fallout. Congressional records show that recipients of TARP repaid their loans with interest, but the broader cost was paid in lost homes, gutted neighborhoods, and destroyed savings. The pattern is hard to ignore. When crisis hits, the system moves quickly to rescue capital, while leaving workers and families to weather the storm alone. This cycle of public risk and private reward did not begin in 2008, and it has not ended since. It is a template that shapes every financial emergency, quietly reinforcing the gap between those who hold assets and those who live paycheck to paycheck. Picture 2 people earning the same total income, $150,000 in a year. One collects every dollar as a paycheck. The other splits it. $50,000 from wages, $100,000 from investments and capital gains. When tax time arrives, the difference becomes clear. The wage earner faces a top federal rate of 37%. Payroll taxes take another slice. After deductions, their effective tax rate can approach 30% or more, leaving just over $105,000. The investor's story looks different. Most of their income, capital gains, and qualified dividends faces a top rate of 20%. No payroll taxes apply. Their effective tax rate often lands near 18%, sometimes less. That is an extra $18,000 or more kept, just from the composition of their income. This is not a loophole or a trick. It is the result of deliberate policy choices. Since the 1980s, Congress has favored income from wealth, stocks, real estate, and business ownership over income from work. Emmanuel Saez and Gabriel Zucman, economists at UC Berkeley, have mapped this divide in detail. Their research shows that for the wealthiest Americans, effective tax rates on capital income have fallen steadily. while wage earners continue to shoulder the largest share. The top marginal rate on capital gains has not exceeded 20% since 2003, while wage earners at the top face a rate nearly twice as high. The structure of the tax code quietly rewards those who own, not those who work. Payroll taxes, which fund Social Security and Medicare, apply only to wages. Capital income escapes them entirely. Deductions and write-offs further reduce taxable income for asset owners. The result, year after year, is that people who live off investments keep a greater share of their income than people who rely on a paycheck, even when their total earnings are the same. For most Americans, the promise was simple: work hard, earn more, move up. But the design of the tax system means that the real advantage goes to those who already own assets. The rules do not just set the rates, they decide who gets to keep more of what they earn and who pays for the rest. Asset ownership in America is more than a status symbol. It is the dividing line between those who gain from growth and those who struggle to keep up. Federal Reserve data from the first quarter of 2025 shows that the top 10% of households control the overwhelming majority of stocks, bonds, and real estate. The top 20% hold more than 71% of all household wealth, while the bottom half own just 2.5%. This concentration is not just a snapshot, it is the product of decades of compounding returns. When inflation hits, that gap widens even further. For families with few or no assets, rising prices mean higher rent, more expensive groceries, and shrinking purchasing power. For those who own stocks, homes, or businesses, inflation often brings a windfall. Asset values tend to rise faster than wages, turning price increases into wealth gains for the already affluent. A home bought for $200,000 in 2010 might be worth $400,000 in 2025. Not because its walls changed, but because the system rewards ownership during inflationary times. Economist Thomas Piketty describes this dynamic with a simple formula: R is greater than G. The rate of return on capital, meaning stocks, real estate, and business profits, consistently outpaces the growth of the broader economy. When R exceeds G, wealth does not just accumulate, it accelerates, passing from one generation to the next. This is why a family with assets can see their net worth double or triple over a decade, while a family relying on wages fights to stay even. Policy choices have amplified this divide. Tax advantages for capital gains, mortgage interest deductions, and preferential treatment for investment income all tilt the scales. The outcome is visible on every wealth map. The same households that benefit from rising markets also catch the upside of inflation, while everyone else shoulders the cost. Ownership is not just about comfort, it is the engine that drives inequality, quietly compounding gains for those already ahead. Marcus graduated in 2013 with a degree in biology and $57,000 in federal student loans. He found work quickly, but his paychecks barely covered rent and groceries. When he lost his job during a round of layoffs in 2017, his loan servicer offered forbearance, pausing payments but letting interest pile up. By the time Marcus found steady work again, his balance had ballooned to over $70,000. He enrolled in an income-driven repayment plan, sending in $240 a month, but each year the total owed kept rising, not falling. Marcus is not alone. Since the Bankruptcy Abuse Prevention and Consumer Protection Act passed in 2005, federal law has made it nearly impossible to erase student debt through bankruptcy. Unlike credit card balances or medical bills, student loans follow borrowers for life, surviving job loss, illness, even retirement. The law's supporters said it would prevent abuse, but the result is a generation of Americans locked into debt that can never be discharged, no matter the hardship. For Marcus, that means no savings, no chance to buy a home, and little hope of building wealth. The rules ensure that debt is not just a temporary setback, it becomes a permanent barrier, shaping every financial decision that follows. In the years after the 2008 foreclosure crisis, Wall Street found a new frontier: single-family homes. Private equity giants like Blackstone, through its company Invitation Homes, began buying up tens of thousands of houses in cities hit hardest by the crash: Phoenix, Atlanta, and beyond. Entire neighborhoods that once promised stability for working families became portfolios for distant investors. By 2012, Blackstone alone had acquired more than 30,000 homes, often purchasing them in bulk at auction, sight unseen. Housing journalist Maya Dukmasova describes how this wave of institutional buying changed the meaning of home. For families renting from companies like Invitation Homes, the experience often meant rising rents, surprise fees, and maintenance calls that went unanswered for weeks. Tenants like Alicia in suburban Atlanta found their rent climbing by hundreds of dollars a year, with eviction notices arriving after a single late payment. "It's not just a landlord," she says. "It's a corporation. You don't talk to a person, you talk to a portal." Federal housing data confirms the trend. As Wall Street firms snapped up properties, the rate of owner-occupied homes in these markets fell, and prices rose faster than local incomes. The promise of home ownership, once the backbone of middle-class security, became harder to reach, especially for first-time buyers. For investors, homes became assets to extract value from. For tenants, shelter became less stable, more expensive, and further out of reach. Advice columns and financial gurus love to tell a simple story. If you are struggling, you must have made bad choices. But the numbers tell a different story, one that is written into the rules of the economy itself. The Bureau of Labor Statistics reports that as of the second quarter of 2025, the median white worker earned 24% more than the median black worker and about 29% more than the median Latino worker. These gaps persist across industries, education levels, and generations. It is not about lattes or budgeting apps. It is about who gets a fair shot and who faces barriers at every turn. Decades of data show that racial wage gaps do not shrink with higher education or experience. In fact, black college graduates earn less, on average, than white workers with only some college education. Meanwhile, legal structures and hiring practices reinforce inequality, and black and Latino workers are more likely to be offered lower pay, fewer benefits, and less stable hours, even in the same roles. For many, debt becomes the only option to cover emergencies or bridge periods of unemployment, compounding disadvantage over time. Union advocate Teresa Johnson says you cannot budget your way out of a system that is designed to keep you behind. The wage gap is not about personal failure. It is about choices made by people in power. The story of who gets ahead and who falls behind is not written by individual decisions. It is written by policy, by history, and by the rules that decide whose work is valued and whose is discounted. Today, the gap between productivity and pay is wider than at any point in modern history. As policies continue to tilt benefits upward, most Americans face harder choices just to stand still. Economic rules shape daily reality, not just distant markets. Until those rules change, the promise of progress remains out of reach for millions. The question is, who gets to decide what's fair? Share your perspective below.